What's up, everybody? It's a new month. We're going into September, so it's once again time for 2 deep value stocks. We do this every month. Now, the first company is one that I have talked about before on the channel. It's a company that I own, but they just released earnings. It's a high quality business that's growing, trading for a single digit multiple. I think we're being offered an exceptional price today, so we have to talk about it again. The second stock is a new one. I don't own it. It's on my watch list. It's also trading for what appears to be a very cheap valuation, and I don't think I've seen anyone talk about it on YouTube at all. As always, if you get value out of the video, subscribe to the channel. I can't believe that we have passed 2,800 subscribers here, so thank you so much to everyone who's followed. And if you want to help the channel grow, apparently there's a new feature on YouTube called Hype. I think it's similar to liking a video, but you can only do it for 3 videos a week, so I guess you have to be selective. In any case, it's free, so if the option to Hype is down below and you feel like I've deserved it, then I would so appreciate any support in helping out the channel. Now, let's get into this first company, and it is JD.com. Now, JD is a company that I've talked about before on the channel. It is a company I do own in my portfolio. It is an absolute monster of an e-commerce company in China. It is a competitive market. Along with JD, you have Alibaba, you have Pinduoduo, you have Douyin, you have Kuaishou. But JD is a bit different from the others. They do have something that sets them apart, and that's their logistics infrastructure. If you live in a major city in China, you can get something on JD in less than a day. Even if you don't live in a major city, you're probably getting something delivered to you in 2 days or less. And that's because they own a ton of warehouses. I think about 35 or 3,600 warehouses across China. They really are the Amazon of China. If you think, just what makes Amazon retail so special? Why don't people buy more on, Walmart or Target, or maybe from Temu, whose parent company, by the way, is Pinduoduo, is a competitor of JD. I would say that one of the biggest differentiators for Amazon is that for most places in the US, they will deliver to you next day. You can't build out an infrastructure network like this overnight, and that's why I think JD has a lasting advantage. They're also known for having a little bit more reliable quality than some of the vendors on, say, Alibaba. Alibaba is essentially just operating a marketplace with Taobao and Tmall. They are connecting sellers and vendors, but for the most part, they're not buying the goods themselves to sell to the consumer. For JD, a lot of the goods they are selling are items that they have purchased from vendors. They're not just a marketplace, they're the seller. So their margins are low. The margins on this kind of model, like Amazon, are, single digits. And even though margins are low, they are steadily improving them over time. On their most recent earnings call, they said our gross margin reached 15.9% in Q2, marking the 13th consecutive quarter of gross margin expansion. As they expand, they're becoming more efficient, margins are going up. Management has said that, by 2027, we're going to be hitting 5% operating margins. And that's a big part of my thesis here. Revenue growth might not be insane, but as they expand margins, the bottom line growth is going to be much greater than people think. Now, even though I wasn't forecasting incredible growth on the top line, they actually have grown revenue massively this quarter. Net revenue up 22% year over year is huge, a lot more than people were thinking. But, there's some reasons why this number is big. First of all, the Chinese government has offered subsidies on certain items to stimulate the consumer. So a lot of electronics, if you want a new fridge or something, guess what? The government is going to give you a subsidy for that. So JD in their electronics and home appliances segment up over 23% year over year. That growth is not sustainable. But even still, looking at general merchandise up 16% year over year, whichever way you cut it, the growth is actually accelerating in this company. For their core business of JD Retail, not only net revenue up 21%, again, this is somewhat boosted by subsidies, but as far as operating income, this was a record for their core business in terms of operating profitability. Operating margin year over year continues to improve. So that's the good news. Now let's get into what has some investors a little bit worried. We see this new businesses segment right here, which went from a year ago basically being almost non-existent to now in this quarter, they have a massive loss. What is this segment? What is going on here? Well, JD has decided to step into the food delivery game. They're trying to compete with Meituan and Alibaba for business here. It's basically like a 3-way Uber Eats war that is going on in China. They've put a lot of money in this. They're incentivizing delivery people. They're incentivizing customers to try out their delivery service. And we see the effects on their cash flow. Cash flow is down a lot. So the question is this going to pay off? Is this just going to be a cash flow sink, a black hole where cash just goes into this and it never really becomes a profitable segment of their business? Now, they have scaled here quickly. They say at the end of Q2, the number of food delivery riders on JD have exceeded 150,000. We know from Meituan's results that JD has eaten into Meituan's market share here. Again, Meituan is the market leader right now in food delivery. They say food delivery business has brought in an increasing number of young users and significantly boosted JD Plus members' shopping frequency. We continue to accelerate cross-selling from food delivery to on-demand retail. So they think there's synergies here, and I will say, JD's team gets a lot of slack. Richard Liu is no longer the CEO, but he is the chairman, and he is an incredible business leader. Like with building out their infrastructure network, he's willing to make investments that might not pay off in the short term, but will reap rewards in the long run. I think they deserve the benefit of the doubt. I think this is an excellent team, and I think if this company was in any country other than China, they would be worth a ton more than they are today. So with that said, what can we expect for a return on our investment with JD.com? My base case, I was only assuming 4% revenue growth a year, which is looking like it's going to be pitifully low. I probably should increase this number, but given that some of the growth is going to be coming from food delivery, and I don't know how profitable that's going to be, I'm just going to leave my numbers as they are for now. Their operating margin, I have hitting 5% in 5 years. Again, the company actually forecasts them to hit this in 2027. I believe management, but I just want to be conservative here. I have brought down their free cash flow margin a bit in light of the fact that they're going to be putting money into food delivery. Maybe I should bring this down even more. If I just give them a 1% margin for the next 3 years and a 10 times multiple 5 years from now, you're looking at a 25% annualized return on JD stock today. I just think this company is absurdly cheap. They are growing the top line at double digits. They are trading for a single digit multiple right now, and I think margins are going to expand significantly. Obviously, the elephant in the room here is that this is a Chinese company, and if that just means that it's a no for you, that you won't invest in this, that's totally fine. I actually completely understand that point of view. I'm not trying to convince anyone to buy JD.com. I think I just want to take a moment and explain my thoughts when it comes to investing in countries that we maybe deem more risky. Country risk is certainly something we should take into account. It is something I think about. If you follow the channel, you know that I own StoneCo, which is in Brazil. I own Kaspi, which is in Kazakhstan. I own 3 Chinese companies, JD, Alibaba, and Finvolution, which JD.com is the largest position, but collectively they make up 10% of my portfolio. I never want to be too exposed to any geography that I consider to be especially risky, which, just to be clear, I do consider China to be a risky market. And when I'm looking at companies in these markets, I want an extra margin of safety. If I could find a dozen businesses in the US that are as strong competitively as JD or Kaspi and trading for anywhere close to a similar valuation, then I wouldn't be investing in these companies. I don't enjoy taking on country risk, but as long as I manage my exposure to it, I'm not afraid to take on a little bit in my portfolio either. For these types of companies, I build in a lot of pessimism into my bear case. And actually, let me just talk about it here. My bear case, I'm assuming no revenue growth. This is kind of ridiculous, but I also made this case when it looked like China's economy was a bit more stagnant than it is right now. I'm assuming operating margins fall woefully short where management thinks they will get to, and I'm only giving them a 6 times multiple. A powerful business like this trading for just 6 times operating income is what I think we might expect in a sell everything China event, as I say here. If China does something crazy, if JD shares get delisted from American stock exchanges, then yes, that would be a bad day for me for this investment. But there comes a price where, for me, in my opinion, an excellent business like this just becomes too cheap. The risk reward becomes just too asymmetric, too skewed in my favor. And another thing I'm more focused on with these types of foreign companies is, are they returning value to shareholders? As a shareholder in JD.com, I have less power. I have less say than I would being a shareholder in an American company. So I want to make sure that management is aligned with me. Management is working on the best interests of their shareholders. And in the case of JD.com, they have a dividend. They're continuing to buy back shares. The shareholder returns here are actually quite good. And I like the management team. I'm getting paid to wait here with my JD shares. I don't think this company will ever trade for a similar multiple to Amazon or a comparable American company, nor do I think they should. My model is not assuming that. Again, base case, I'm only giving them a 10 times multiple 5 years from now. So I think with conservative assumptions, I'm looking at a fantastic return. As far as what I'm doing with my position here, I'm certainly not going to sell. I might add if it gets cheaper, but I also don't want my exposure to Chinese stocks in my portfolio to be too large. I'm probably just going to do my favorite thing, which is nothing. I'm just going to sit here with my shares. Now let's talk about the second company. And by the way, a lot of people have asked where they can get my sheets. I am going to be starting a Patreon soon, hopefully in just a few weeks, and I will have my Google Sheets on there for people to download. Now let's get into the second company, and it is Dine Brands, ticker symbol DIN. If you don't know what this company is, let me just entice you with some numbers before I tell you, because once you find out, you're probably going to say, oh man, I would never invest in that. Dine Brands is trading for less than 5 times cash flow, about 5 times next year's earnings. They pay a massive 9% dividend. So what is this company? Well, Dine Brands owns Applebee's, they own IHOP, and they also own Fuzzy's Taco Shop, which is such a small part of revenue. We're not even going to talk about it. I know the restaurant business isn't very interesting, a lot of competition, low margins, especially for this company. When a lot of people hear Applebee's, they just think, some dying restaurant that they used to go to maybe 15 years ago. For clarity, I don't own this stock, but the numbers just got so cheap where I have to do a deep dive into this. This is what I do. I look for companies that other people just don't want to touch, that they just push to the side, and sometimes there's value there. Sometimes we should stay away. We see from our stock chart here that it's basically been a one-way trip for Dine Brands shareholders over the past 4 years, from about $100 a share all the way down to right now in the low 20s. You're down more than 75% on this thing if you've held it the whole way. Dine Brands recently is trading for about the level it traded at during the peak of COVID fear. Now, just because a stock is down certainly does not mean it's a buy, but it's a gauge of sentiment. While the valuation is cheap, there's likely a good reason. I mean, when we just glance at their metrics, there doesn't seem to be a lot of reason for optimism. It looks like revenue completely collapsed here from 2008 to 2013, but this is mainly because they shifted their business model. They used to own a lot of their restaurants, and now they're almost exclusively a franchisee model. So they don't actually own the stores, the Applebee's, the IHOP. They license them to franchisees. So that means that the revenue came down here. But as far as operating income, bottom line, what we're really concerned about as shareholders, it was looking pretty good for a lot of the last decade. It was flat and there wasn't much growth, but margins were decent. Trailing 12 months, margins are down a little bit. They had some small asset write-downs that are hurting this a little bit. And also something that certainly can't be overlooked with this company, they have a relatively significant amount of debt. Long-term debt, if I add in the current portion of that, we're looking at like $1.2 billion. If you want to add in their capital leases here, you're more like 1.5, 1.6 billion. It's come down a little, but relative to their operating income, this is a lot of debt. Whenever there's a ton of debt on the books, you're going to want to know, what are their obligations there? What do the maturities look like? So if you just go into their 10K and you type in maturity or maturities, you're eventually going to find it in here. Actually, for this company, we had to search long-term debt to find it. Usually maturities just gets you there faster. Actually, this company is kind of reporting this in an unusual way. Typically, they would have a table that tells you when the maturity is coming due, not just a table that says, series 2019. I mean, this is when the debt was issued. Okay, so I just paused and read through what in the world is going on with this company's debt because it's a bit more involved than you normally see for a typical company. The bottom line here is that these obligations, they're over $1 billion in obligations here. They are mostly fairly long-dated debt. They're maturing in 2049 and 2053, so they have a ton of time. However, if they don't repay this loan by 2026, by next year, then their interest that they have to pay on this will go up significantly. It sounds like their interest payment would likely increase by 5%, which would make this between a 9 and a 10% annual obligation that they would have to pay on this debt. So pretty significant increase. Maybe they're looking to roll this debt over. It's definitely something to look into. Now, looking at the free cash flow for this company, I can see why a value investor might be interested here. The cash flow is still fairly strong, $90 to $100 million here in free cash flow. Annual CapEx is low, so a lot of this cash from operations, they're able to pay back in the form of a dividend. They've also been buying back shares. Now, arguably, a lot of these buybacks were done at significantly higher prices where it seems like they weren't getting a really good deal. Most of them were in 2022. So where was the stock in 2022? $60 to $80 a share. That's where they were buying back most of their stock. Now, the other reason that this company piqued my interest a little bit and I decided that I wanted to include it in this video is the CEO and the CFO of this company both bought shares quite recently in the past month. On August 19th, the CEO bought about $100,000 worth of shares, and just 2 days later, on August 21st, the CFO bought about $50,000 worth of shares. Relative to their holdings, and I'm sure relative to their net worth, these aren't massive purchases, but still, whenever the management team of a company is buying in, I want to take a look. Typically, there's one reason people buy, and that's because they think the stock price is going to go up, or they think the shares at the price they're buying at are significantly undervalued. For me, this is going to come down to our thoughts on where we think the future of Applebee's and IHOP is going to be. Just so you know, I love IHOP. We maybe eat there once every few months, not sure, but always have a good time. Recently, management has been talking about combining an IHOP and Applebee's kind of combo franchise. My initial impression is that sounds kind of weird to have, one building and it's both an IHOP and an Applebee's. But, thinking about it more, it kind of makes sense. IHOP is a breakfast destination primarily. Applebee's, primarily dinner. They do naturally complement each other. When one is having their downtime, the other is having their peak customer time. So maybe that could work. Maybe that could improve operating efficiency. I'm not sure. The other thing to mention is that Applebee's, this dead and dying restaurant, has recently had a little bit of a comeback. I showed this in my Kava video. Applebee's Q2 same-store sales was up almost 5% year on year. That puts it ahead of Taco Bell, McDonald's, a lot of other brands. Now, IHOP, we should mention, was down about 2%, so that's not great. But my point is, this company is not necessarily dead. And you wouldn't know that by the way it's being priced. It's being priced like it is dead, that is for sure. So let's go to our sheet. Let's see what we could expect for a return on our investment in Dine Brands today. If I assume slight declining revenue, I'm going to say minus 2% every year for the next 5 years. I'm assuming that their free cash flow margin comes down a bit. It's close to 10%, 9-10% right now. Let's bring that down to 8. And I'm going to assume that their operating margin remains low, about 18%. And we see the problem. This company just actually has so much debt right now that our assumptions of, operating income about $140 million and a 10 times multiple doesn't even make the enterprise value large enough to account for the debt. So, the way my model works, the debt being larger than the enterprise value, it's basically saying, in 5 years, market cap's going to be non-existent. Basically, there's so much leverage built in because of the debt that if we change these numbers a little bit, you're going to see drastic changes in the IRR. I mean, just to show you what I mean, if I change this to a 15 times multiple, all of a sudden the IRR is a massive 26%. And you see what's going on here. When we change the multiple from a 10 to a 15, you're increasing the enterprise value by 50%. But the effect that that has on the market cap is not 50%. Because you have so much debt, you have this leverage. So the market cap is going from non-existent, a negative number, to $600 million. Just to illustrate, the enterprise value is about $1.8 billion. If that increases by 10%, just a 10% increase in enterprise value, that would add $180 million to the market cap, which would increase the market cap by 50%. So there's massive upside potential here, but for me, I can't buy into this stock today. The debt is too large. They don't really have significant assets to compensate for that. The operating income that I see in the future, I just don't have enough confidence here. I have some concerns about the margins. So, even though it looks like value, even though the stock is down 75%, and even though management is buying into this thing, this is definitely encouraging. And I think that there is a ton of potential upside here. The reward is definitely there. My concern is the risk, the other side of that coin. The risk, I think, is too high for me. So even though this looks like deep value, it's going to be a pass for me today. In any case, if you got value out of the video, subscribe to the channel. I have 2 more companies that I own that are in my portfolio that also released earnings. I think they definitely look like value and they're worth an update. So I'm going to do another video going over those 2 within the next week or 2. If you agree or disagree with anything I said in this video, leave that down in a comment below. And I hope to see you all in another video.